Hello, ladies and gentlemen. This is Modern Investing on Bot TV. My name is Sasha Star, and today's guests are Dr. Milan Sombrag. Welcome to the show, Milan.
Delighted to be here. Thank you for inviting me.
Of course. And producer of Bot TV, Mark Lee. Welcome to the show, Mark. Hopefully you will be able to ask questions that you're concentrating on. Welcome to the show, Mark.
Yeah, if I pop in for a minute, like I said, I'm gonna let y'all go and carry the conversation. I might pop in with some other questions as I've got a bunch of things going on this side and everything, but hope everybody is doing well and y'all are doing well there in Canada. Things are going well here in North Carolina. Like I told you before, everybody's getting excited about investments and particularly sports investments as we got sports betting going on here now and all along those lines. And of course, we've now got the sports tournaments that are going to start. So the ACC, I was actually talking to my aunt earlier today and she's getting all excited. So some people will be possibly letting their money slide out because the money will be going into that nature and everything. And I know a lot of times y'all are one of them to do smart investment, but sometimes people get lucky and they win money doing this kind of thing. But I'm gonna turn it over to y'all and maybe y'all have some thoughts around sports betting since FanDuel, 365 bets, and I want to say even ESPN or one of the other ones has gotten here, ESPN bets. So a number of these betting companies have joined North Carolina because on March 11th, we became an official sports betting place.
Well, congratulations. Ontario is doing quite well in sport betting, and we have all the sites available for a long time. And but Mark, I want you to be aware, and I would like to know Milan's opinion, that sport betting, you cannot qualify it as investment per se. I think it's a nice kind of possibility for people to have more fun and to appreciate sporting events. For example, when I'm betting on European soccer, I enjoy games much more than I wouldn't put any bets. And
Right.
but again, it's hardly to do anything with investments. Milan, what's your opinion?
Well, people who bet on sports win often enough to keep them coming back, but not often enough to stay ahead overall.
Yeah, it's not even the results. Is that the betting sites are doing very well in any case, unlike individual bettors. However, it's fun, but as I said before, it's not really investment purpose. So, so it's something different. Now, today is Wednesday. Market is up. Technology stocks are down for most of them. Of course, NVIDIA is a very special case. And in my opinion, if you look at the chart of NVIDIA, it's went almost vertical type of advance from around, there was a resistance for a while at $500 a share. And then it broke decisively out of 500 and went up to 900 or so, almost in vertical type of chart. But you have to admit that nothing can go only one way, up almost in vertical fashion. It's impossible, and there has to be some kind of retracement, and a new base has to be formed where I don't think that NVIDIA will go below 700, which is halfway between 500 base that it has about a few months ago to 900, almost, as I said, in vertical fashion. So it could retrace about half of the gains, which means between 5 and 900 to 700. I doubt, because of specifics of NVIDIA, that it would go as low as 700. But even if it will stay around 850, 900, a level for a while, and it will create a base. That's what's lacking, in my opinion. There is no base. It's just going straight up, and it has to go to a level where there will be about equal amount of people who want to buy shares and sell shares, and maybe stays there for a while. We'll see which way we'll go. I mitigated my position in NVIDIA this way. I have an entry which I looked just today in my personal account, the so-called fun account, although it went to the size that you can no longer call it a fun account, but it still technically is. And on a day before Friday, on Thursday exactly to be, I sold, believe it or not, 1,000 shares of NVIDIA. Now, I would like to people to understand, of course, I never had at any one time 1,000 shares of NVIDIA. No. The maximum I had only 700 shares of NVIDIA, but also I had sold the cash-covered puts. So with all that, I had, say, 800 shares of NVIDIA. But that day on Thursday, I was doing a couple of trades back and forth. And so when I decided to liquidate position, I've sold 1,000 shares, which closed the day trades and the my total position. Now, what's happened next day on Friday? The shares opened sharply higher, and I started to regret that I sold so many shares because I'm leaving a lot of money on the table. And so I did kind of a funny thing. I bought 200 shares of NVIDIA, and I sold deep in the money calls. Now, to be precise, I'll tell you exactly numbers and which calls I've sold, which makes me very happy as the retracement later on Friday happened and Monday. Although yesterday was quite spectacular day up for NVIDIA, today it's going down. It's trading about 890 something a share. But what I would like to mention is that Friday, when I bought 200 shares, I sold 200 covered calls. Now, you will be surprised, but I sold December 20, 960 calls, which is still out of the money. However, for each call, I got $190.17. Okay, forget about 17 cents. 190 is $19,000. So for two calls, I got $38,000. Not only that, I sold cash-covered puts, 3 of those, and I sold also December 20, 920 puts. They're still a little bit out of the money, but for each one, I was paid $137.50, which is $13,776. $30,760. So that, of course, for each one, I sold 3. So it's $52,000 or something. So that provides me a very nice cushion to withstand the base formation for NVIDIA for next probably couple of weeks, 3, maybe more weeks. The next report will be in May. So most likely, the way I see it, it will form a base from which then it could take an onslaught on $1,000 a share. So that's how I'm playing it. Hopefully I'm right. Maybe not. Maybe right, but partially right. We'll see. We'll see if it's a matter of next few weeks. Although it could decisively, if tomorrow PPI report will be positive, it can break even tomorrow. Depends on the report. But we'll see which it will be done. Now, speaking about buying this even 200 shares, or it doesn't matter how many shares, we have a discussion on this program very often, especially with you, Milan, about that whatever you are buying it from somebody else who is selling, and only one could be right. Milan, this is quite controversial statement because even if you're buying ETF S&P 500, you are buying that units from somebody else.
There are occasions when both can be right. That's true. But there are some new forces acting on the market overall that will affect NVIDIA as well. And that is an inverted yield curve have preceded every recession in the last 60 years. Just to define a yield curve, a bond, for instance, the further out we go with a bond, the greater the return is. If the closer date is a greater return than further out, we have an inverted yield curve.
Agreed.
So, as recently as 2 days ago, I wrote in this publication that I issue on Mondays for my members, the Monday Morning Millionaires. We have about 300 members. I said, unlike the put-call ratio, which is sometimes difficult to interpret, and you don't pay much attention to the put-call ratio, and probably for good reason, it is difficult to interpret. But unlike the put-call ratio, an inverted yield curve always predicts a recession. And we have an inverted yield curve today. But that's what I wrote on Monday. As recently as yesterday, a group of analysts who were surveyed by Reuters, 60% of them said that an inverted yield curve is no longer reliable as a predictor of a recession. But not 100% of them, 60%. So, that goes to support the idea that nothing works all the time. The only thing that works all the time is buying a stock as it declines. The entire U.S. market, that works all the time. It's always an advantage to buy more as it drops, as it becomes cheap, and to sell it to take profits. The opposite happens with most investors. As SPY, which represents the S&P 500, drops, most people are running for the doors. The same people who drive across town to save a few bucks on groceries are running for the doors when the market is a bargain. When the market is rising, when they should be taking profits, most of them are jumping on board. So part of the reason why the put-call ratio doesn't work effectively is because most investors are wrong most of the time, I think. But right now, we have an inverted yield curve, which in the past 60 years has always predicted a recession. Now, according to a survey completed by Reuters, 60% or more of analysts and advisors think that is not a reliable indicator of a coming recession any longer.
About recession, Emil, very quick question. You mean recession is the contraction of a U.S. economy, which means the company profits will go down and so on. You're talking about recession, whereas a downturn of stocks. They're two different things. I don't see any indication that the U.S. economy is slowing down and may go to recession. Right now, I really don't see indication, because if you look at corporate reporting from the beginning of the year, although the end of
You're right.
the earnings are spectacular, and I really don't see any single indication of the upcoming recession as the contraction of U.S. corporate profits. Now, the market is a different thing, because, as I said, in case of NVIDIA, nothing can go just vertically up all the time, so there has to be retracement. And if that's correct, even for a stock like NVIDIA, it may be correct for other stocks as well. Although, for example, look at the reports of Oracle, and it went up $12% after its report. So the corporate earnings are still spectacular, and therefore, It's very difficult for me to argue is that the recession is imminent or there are all signs of recessions. Are there? Where is a recession? I really don't see a recession. It could develop at some time, maybe later on the year, maybe sometimes, maybe the end of April, beginning of May. That probably, historically speaking, that's where the market
What
may.
would you have said, Sasha, what would you have said if this discussion that we are now having took place 1 week ago when an inverted yield curve predicted accurately a recession for the last 60 years? Every recession in the last 60 years was predicted by an inverted yield curve. We're having the discussion a week ago. What would you have said then?
I would say that it could be that this inverted yield could last for a number of days, maybe even weeks, but it's not something that is staying for a long time, let's see, a few months. That would be a very serious indication of a recession. But it's not the case. It fluctuates as anything else. Mark, you have a question for us?
Yeah, I did have a question for you all really quickly. It was actually, sorry that it took me a minute to jump off, but one of the companies I work for is an education company. So I was getting a letter and a phone call from them and everything. But one of the things I was curious about, because I know Nick brings it up quite a bit, is in Canada, do they teach enough about investment and fiscal literacy in the school system? So I was just wondering if this is something that is taught, and if it is taught, where is it taught, and do other countries do a better job of teaching about investment just in general? Because I know that one of the things that Nick, our founder, talks about is this need for fiscal literacy and wanting to have people taught better about how to invest. So since y'all are investment folks, I was just wondering.
To answer your question, Mark, about 10 years ago, Northwestern University had a dental school. It no longer has, but that dental school would offer a dental MBA to graduates of the dental school program. They're finished their dental school training. They have a DDS, and now they can spend an additional 1 year in which they earn a dental MBA. So that no longer exists. And currently, no school provides such training. So people have to get it privately, and people who offer these courses are always looking for wallet access, no question about it. And so what we do is we show people how they can look after their own investments. You know, the number one, there's 6 points that we take into account. Number one is save. If you don't save, the other 5 don't work. Number 2 is do it yourself, because doing it yourself is not difficult. You can teach a high school student how to invest in the entire market doing it himself in less than 2 minutes. Easy to do. Almost impossible to beat. Almost impossible to beat. So picking individual stocks or timing markets simply doesn't work compared to owning the U.S. market as a whole. So asset security selection, I'm quoting David Svensson, the most successful manager of university endowment programs. He said, security selection and market timing make no material contribution to returns. He also said, when you look at the results on an after-tax basis over a reasonably long period of time, we're talking 10 years here, there's almost no chance that you end up beating an index fund. Now, there is the occasional Mozart in this, like Sasha Starr. You've been beating the index fund. Most investors are not Mozarts. Most investors can't do it. Most investors shouldn't even try, except in their fund portfolio. And when it comes to a fund portfolio, I say to investors, keep in mind 2 things. One is put enough money into your fund portfolio, put a sufficient amount of money, put such an amount of money into your fund portfolio that if you lose it all, it will not change the way you live. That's important, number one. Number 2 is don't keep track of your records, because you're sure to be disappointed. So, you know, every once in a while, there's an outlier. Warren Buffett, for instance, you know, I mentioned the other day that he's got nearly $1 trillion in cash. and you told me how much bigger NVIDIA was. Well, I'm talking here cash, not investments. Warren Buffett's investments are bigger than NVIDIA for sure. But he's got cash, which is sitting idle. He doesn't know what to do with it. He can't do anything worthwhile. But there is an outlier. There is a market outlier. You could well be one, Sasha. And so this style of investing doesn't apply to you. But most people cannot beat the business of buying the
That
S&P.
makes a lot of sense. Hey, Sasha, just really quickly, if I can, just a follow-up question for you. As I said, I was talking to my aunt, and my aunt was telling me about her grandkids, and some of these grandkids are now going into the work world. One of them is working in New York in an advertising agency. Another one is working in D.C. in the athletic field, and another one is getting into North Carolina in the athletic field as well. And I think in a second master's, and another one is actually getting ready to get a degree in education. So these are all folks that are, say, between the ages of mid-20s to like the early 30s, and all in that space. So none of us here on this screen are exactly not seasoned, because I know I'm in my early 60s, and both of you gentlemen are a little bit older than myself and everything. But what advice would you give to folks that are youngsters that are thinking that they want to get into the investment space? So what advice would you give to young people that want to invest?
Well, there was a survey done a few years ago. I've forgotten who conducted the survey, asking that very question. And the answer by the vast majority was, I would have started saving earlier. And that applies to me too. When I graduated, I was making so much money. Dentists make a lot of money. So I was making so much money. I was spending it like it was the money was disappearing out of my wallet so quickly, because I felt empowered by being able to not be concerned about the cost of things. And I wish I had started saving earlier. And the answer that most people gave was exactly that. If they had their life to live over again, what would they do differently? The majority said, I would have started saving earlier, which is the right answer.
Bill, and I would agree with you, although in my life, I was never a saver. Never, ever. I was making money and I was spending money. And then early enough, I went into investments basically by fluke. As I said probably on one of the programs, I was in the office in Vancouver of Duncan Sattles, who at that time had a junior company, Microstat Developments, and it was trading at 50 cents. And I was impressed. We went to the office Sunday night that people were working there, and I asked him why they're working on Sunday night, and he told me that they're about to release a new software for stock market professionals or so on. And when I came back to Toronto, and I asked stockbroker that I was friendly with to start buying shares for me. And she told me that never, ever she will allow me to buy these shares. It's a penny stock. It's garbage. How dare you even think about it? And I said, well, okay, if you will not do that, I'll find a broker who will do that. She very reluctantly bought for me some shares at 50 cents, then more shares at 60 cents, and even more shares at 70 cents, and so on. So my average was, at the end of the day, $1.55. The stock went as high as $4.70, and I had hundreds of thousands of shares. So basically, I made my first big profit in that company. Now, it was a fluke from beginning to the end. It was a fluke how I stumbled into that investment and how it performed and so on. But anyway, if I didn't do it, that would never happen to me. And I probably...
Sasha, you're talking here about what modern investing is about, which is momentum investing. The higher up a stock goes, the more of it you buy, which is contrary to take profits when the stock goes up. But momentum investing works unquestionably. The thing is that all good things come to an end, and sooner or later that momentum will turn around and start heading in the other direction, which means that you have to pay attention to it constantly. If you enjoy that sort of a thing, and many people do, absolutely momentum investing works. The downside being it needs constant attention, which doesn't apply to most of our members of Monday Morning Millionaire. Most of them are professionals and still working, and they're making more money doing their job, be it medicine, dentistry, engineering, architecture, whatever it is, than in investing. You could make better money in investing if you do momentum investing and pay attention to it constantly. Enjoy that by all means. That's the way to go.
Milan, many times I have demonstrated this book, Market Wizards, which I'm following and read and reread it quite often. And the system where you add up to your investment, which is going higher in price, they don't call it a momentum investment. They call it averaging up. There are a lot of people who average down. And here are a few words about merits of averaging up. Let's see if you have stock at which say $100 a share, and it went up to 200, and you add up the same number of shares. So your average cost now is $150 a share for a stock which is trading 200. Okay, so you're still ahead of the game, but you doubled your position. And as a trend is concerned, the most likely scenario is the stock will go higher. Now, if it's not right and if it will go lower, you're still ahead of the game because your price is average price $150. Stock is trading 200. Say it went down to 175. You're still ahead of the game. Now, if stock will continue its direction higher and higher, you can add another probably 100 shares at 250 or so on. So that's some kind of maybe a pyramid type of scenario. But if you're right and you got the trend, then I would recommend to maximize your results. And there is always a trend to be found. Even if that trend is broken, you can get out of it all and fix up your profits.
Would it be the same as you go to a casino and you bet, let's say on the roulette wheel, a certain amount of money and you lose? Then you double your bet the next time.
I don't do that. No,
and
I don't.
Then you double your bet the next time. You keep doubling. Sooner or later, you're going to come out.
No, I don't do that. And it was several years ago in Aruba, in Stellaris Casino at Marriott, where I played blackjack, and I'm reasonably good player in blackjack. And I lost 30 hands in a row, which is incredible. And I played all the right.
Shouldn't happen statistically, should it?
It's not happening very often. Of course, to me, it happened only one in my lifetime, but it happened. So if you would use, for example, systems that you just described, it's a martingale system. When you keep doubling and doubling and doubling or so on.
That's the name, Martingale. Yeah, okay.
I would be taken to cleaners.
Yeah, of course. After the
So
second.
when I lost 30th hand in a row, the dealer said, well, it's okay, have a bad luck, go to your room, take a rest, and then come back. I said, no, we're continuing to playing, and you will see what's happened. And as soon as the trend changed, I started to use system 1326. So I put the same unit. I was playing $25 a hand. So I played 25. I won. I put 75. I won again. I put 50. Why 50? Because I wanted to fix the profit that I have from 25 and 75. And I put 50, which I still have $50. Even if I lose, I still have $50 plus. And then I would continue. And I won that bet, and I won 6 times that amount. Again, $150 bet, I won. Then I started back again, 1326. I got my money back in a matter of 20 minutes because the trend changed. And I used that to my great advantage. So all you need is to understand when the trend is your friend, as you say, until it's no longer your friend, as you said very wisely. And that's how you have to play the game. You can
the ultimate example of a compliment that a casino can give you is to say, you're not allowed to play anymore. And so that happens to James Eads, for instance, who might join us later on today. He was counting cards, but he was able to keep a track of these cards so well that he wound up ahead in blackjack, to the point that the casino said, you can't play anymore. And that takes a lot of concentration, and that takes a lot of ability to remember what went out and what still remains in the cards and what the odds are for you. But it has been done. And so the ultimate compliment is when a casino says to you, I'm sorry, sir, we can't allow you to play anymore.
It's happened to me in Moscow when I was there several years ago. I think it was the year 2009. And that was a year when casinos were all closed in Moscow. But obviously, prior to that, there were quite a few casinos. And I was playing in one right in the center of Moscow by the name Shangri-La. And not only that I played there, and I was winning almost all the time, and they had lavish complimentary dinners for players. You can have a black caviar, you can have a cognac, you can have almost anything what you desire.
They want you to drink.
You were allowed to
drink.
Sorry?
They want you to drink.
Okay, and I was allowed even to bring friends, which I did very often. So one day there was an English manager of the casino, and he was watching my play almost every day. And he told me that, look, I watch your game, you're not counting the cards, but what you're doing doesn't make you a desirable guest for our casino. And I asked why.
Yeah, what were you doing?
He said that, well, look, the problem is that you're not winning that much money. $2,500 here, $3,000 there, or so on. But you're doing that consistently. We have players who are winning $50,000 a night, but the next night they will come and they will lose $100,000.
Yeah.
We don't see that happen to you, and therefore you are not desirable player.
Great compliment, Sasha. Great compliment. Yeah.
What he said, though, okay, I will allow you to play, let's see, for 1 week. In a machine-generated hands. So there's a shuffle machine. So instead of normal shuffle when dealer does the shuffle and then put it in a shoe, there was a machine. Said that's fine, okay. So same thing happened with the machine, because the systems that I'm using, it doesn't matter the machine. I'm using very simple systems, similar to stock market. All you do, you always know how much money you have on the table. And when you're, let's say you're getting ahead of the game, and from maximum you're losing 10%, you terminate the game, you just stop. You stop playing, you go to another table, you go for a walk, you listen to music. Doesn't matter, you just terminate the process. Same thing as a stock market. Remember how many times I was saying about a rule of William O'Neill. The rule is that you cannot allow to lose more than 7% on your stock position. Of course, in my case, it doesn't apply because I'm playing options, and options, it's a slightly different game. He was referring to stocks only. So if you bought a stock and you lost 7%, out. You know why? Because nobody knows where the stock will stop going down. You can lose next day, it's going to be 8% and then on.
If instead of a stock, you buy the American economy as a whole, and
same thing. But if you lose 7% on your S&P ETF, it's the same thing. You have to terminate.
If you lose 7% on S&P 500, it's in buying territory. It becomes a bargain. How did you select that figure 7%? Why not 8%? Why not 6%? Why not 9%?
Because William O'Neill said so. I didn't analyze the rule 7. Why not 6%?
Why?
You lose less money than if you lose 7%.
Yeah.
But on the other hand, some of his calculation, he didn't really explain that rule properly as the historical examples or anything like that. What he was saying is that the stock lost 7%. First thing what you do, you sell. Once you sold, you have to analyze if today, if you would not have any positions on the stock, is it attractive enough for you to actually buy that stock when it's down 7% from where you bought? and you have to find answer to that question. If you find a positive answer, maybe you should go back and buy that stock after you
Yeah.
sold. Nothing, especially now with such low fees.
Well,
No, sure.
that rule applies to individual stocks, which you recommend against, but it doesn't apply to the 6 habits that we talk about, because as the market drops, it gets into bargain territory. And at 7%, 8, 9%, we would be buying more of the S&P 500.
Yeah, but you know that in typical recession stock, including S&P, will go down 10, maybe even 20%, and
That's
sometimes
okay.
much worse than that. So by following the rule 7%, you eliminate possibility of further quite significant losses. Okay, let's see stock. Let's see a scenario where you lost. You take your loss 7%, and then next couple of days stock reverses, and now it starts going down. Sorry, it's going up. Okay, so that maybe you reevaluate your position and you buy back on the way up. Now you have a positive case for yourself to see that the stock is now going higher and probably will continue to do so, and there is no problem for you. Okay, so you leave 2% on the table, but what's 2% when you're talking about winning 10%, maybe 20%? So 2% isn't significant, but if stock will continue to go lower, then you can just wait, see that the stock will continue to go lower. Finally, it has to stop to go lower. Before stock going higher, it has to stop going lower. So whenever it will find its base, it will form the base, it will stay there for a time, and then it will start to inch higher. That's a time when you can consider to going back and buy your.
Here's a system that was used by a very successful dentist investor who is a bit older than Warren Buffett, who attended the same course that was conducted by Benjamin Graham. And what he said was this: keep half of your money in cash and half in the market as a whole. If the market drops 10%, put a third of your money into it. If it drops another 10%, put all of your money into it. And if it drops another 10%, borrow. And that has worked so well for him.
Milan, this is overall, it's a horrible strategy. It reminds me of martingale strategy in blackjack, which is horrible because even if you win using the strategy from time to time, but one time when it's not going to work, you will lose your pants and more. So it's not a mathematical exercise at all. It means you have to understand what market tells you. Market is a live organism. Market has a logic of its own, and you have to listen what market tells you. If it's going down, there must be a reason why it's going down, and you don't know how far down it will go. Maybe it will go to 8% or 10%, or even the same 7%, doesn't matter. Market is on the way down, and it can go down for some time.
Let me ask you this, Sasha. Will the U.S. market recover when it goes down?
Yeah, but in the meantime, you are red across the board.
Sure.
You're losing money. And what's
it's important not to have money in the market, which you're going to need for essentials. If you're planning a holiday, you want to buy a car, you got to buy groceries, you have to pay your municipal taxes. Those are essentials. That money does not belong in the market. You should have in the market the money you will not need in the next few years. You know that it will recover. The U.S. market has recovered from recessions every time in the last 200 years. It's been the most profitable place to invest. And Confucius said, study the past if you would define the future. The future, all empires have 100% failure rate. But the failure of the American empire is nowhere in sight yet. Everybody wants to be in the American dollar. Never mind the United States has got such an enormous debt load that has to be something they have to deal with. But still, all the money in the world wants to be in the US dollar. Sovereign funds are all looking to be in the US dollar. Why is that? Because it has such a history of winning. the best place to invest, unless you're cherry picking. Stamps have occasionally made more money than being in the market. Some real estate has, and some violins have, and unusual investments have made more money than being in the market. That's called cherry picking. Unless you're cherry picking, the U.S. market has been the best place to invest for nearly 200 years and likely to remain that way, even though empires have a 100% failure rate.
Milan, number one, I'm not discussing the discretionary monies that you need to buy groceries or insurance. I never discuss this aspect of investing. I'm talking about a specifically fund portfolio, which obviously doesn't touch the monies that you need for everyday's necessities. So in that case, the strategy offered by late William O'Neill suggests you to cut your losses and let your winners run, and even to add the positions of the winners. So if the stock, even if S&P ETF is going down, and it went down 7%, there is no indications that it cannot go down 8%, 10%, 15%, and even 20%.
There are several.
Milan, hold on. So what's important is, I'm not saying that once you lost 7%, you stop and you never go back. No, I'm not suggesting that. What I'm suggesting is that there has to be a level when the downward movement will stop. Market cannot go in right away. It has to find its bottom. Whether it's 7%, 10%, or 20%, nobody knows where is the bottom. So you have to sell, wait until market will find its bottom. And once it's coming out of the bottom, then it's an opportune time to get back to your ETF.
You know, Sasha, as you said earlier, the trend is your friend until it isn't. There are several systems that work, and it's important for us not to mix up the systems that work for us. What you're describing here works for you. What I'm describing here, the 6 habits that consist of save. If you don't save, nothing had mattered. Number 2 is do it yourself. Number 3 is buy the American market as a whole, not individual stocks. Number 4 is hold, buy and hold, don't trade. And number 5 is adjust to your buy and hold level when the market throws it off, either by going up or going down. And number 6 is, if you can't explain something to a 12-year-old, don't go into it. Avoid complications.
I would agree with everything what you just said if it applies to your core portfolio.
Yeah,
if
right.
You're talking about fund portfolio, there are different factors in play.
You're right on. Right on.
Yeah, and of course, I'm standing by everything what I'm saying, and I wish people would try to learn a little bit more of what I'm doing, but I guess.
There are people watching and they're learning and everything. I was going to actually compliment you on something you said, Sasha, because it's actually the same strategy that my mother uses, because she sometimes will go to the Indian casinos and definitely gamble at some of those casinos, but she has a certain level of money that she is willing to lose, and once she hits that level, then she walks away all along those lines. So they is definitely one of those folks that has a kind of a limit and everything in that space.
Mark, but if she will listen to what I just said today, she doesn't have to lose all your money. She can lose only 10% of your money that she started to play with. Let's see, very simple example. Let's say she started to play blackjack and she has $1,000. When she lost $100, which is 10% of 1,000, out of the table, of the maybe even the casino. Okay, you can stay in the same casino and just find another table or so on. I remember one time I went on a day trip from Toronto to Atlantic City. So you fly in the morning, 8 o'clock in the morning, and coming back at 11 at night. So I went up, I had $2,500, which was many years ago, 30 even more. And I started to play. I used the same system, went to the table, and I lost $250 out. I went to another table, I lost another $200 out. Finally, I found a table and I started to play and started to build up my bank. And I went up to $3,500, lost $350, which is 10% of maximum, out. So this way you limit your losses and you let your winners grow. So at the end of the day, finally, it was very difficult day because very often, although I was successful at some tables, but I was losing money at other tables. So at the end of the day, finally, my goal was to double my money, to go out with $2,500 and bring back home 5,000. So finally, around dinner time, I had $4,400. And I started to say to myself, wait, why are you so greedy? $4,400. You already make $1,900. So just go away, enjoy yourself, and get back to Toronto. And then, indeed, I went to the promenade and I was walking. And then something occurred to me. What if I just came from Toronto with $4,400 of my own money, and all I want is to win $600? How complicated is this? When that occurred to me, I didn't walk, I ran to the casino, and in a matter of 15 minutes, I made not $600, but about $1,200 or so on. So I made myself a check for $5,000 to my name, and the rest of the money I bought some presents for Nava and some other stuff and so on, and then had dinner and went back to Toronto. So this, your psychological state of mind is also very important what's happening in the market. For example, because of this position in NVIDIA that I sold to deep into the money calls and sold deep into the money the cash covered puts, it gives me such a, okay, in total, we are talking about something worth close to $80,000. So that gives me incredible cushion to withstand any movements of NVIDIA. Actually, NVIDIA is down today, although it's recovering, and I don't want it to recover today because I want NVIDIA to create a little bit of a base. I want it to stay under $900 just for a few days even, never mind.
Sasha, that selling cash covered puts in tax advantaged accounts is not allowed in Canada.
I know the story.
It is allowed in the United States. I recently, just last week, I had a meeting with our member of parliament and I wrote a letter to our Minister of Finance, who is really our vice president, so to speak. If anything happens to Trudeau, our Minister of Finance takes over. I wrote a letter to them suggesting that cash covered puts being allowed to be used in tax advantage accounts would benefit investors. They would make more money. And when they had to cash in those accounts, tax advantaged accounts at the end of their investment careers, the government will make more money. It's really a win-win situation. So I hope to be able to report something positive to you one of these meetings. Now, there's a casino close to here, about 20 minutes away, and I go there fairly regularly. And I go there because the lunches that they offer are fabulous and low cost. And I don't go into the casino to gamble.
If you like lunches, go to Aruba and you will understand what our real lunches are. They have things that are impossible to find in Canada most of the times. But that's another story. I call my Aruba vacation is NVIDIA vacation because I remember I was on the beach and there was NVIDIA's reporting. And I was watching on my iPhone. Okay, so NVIDIA was, I don't remember exact numbers, but $800 some $40 a share, for example. And there was the end of the day, and there is the reporting. So what's happened? Where is the reporting? Because the stock is trading here and there. And then all of a sudden, the stock went down $20. Say, well, probably they have a negative report. Okay, so I went for a swim, coming back. Now it's up $40. So people started to appreciate the significant, very positive report, and it went up even further the same day on the aftermarket trading, and then next day it opened $50 higher. So I regret only one thing. With NVIDIA, I became very disinterested in all other stocks, to tell you the truth, because I figured out that my time, which is very precious, that's the only thing what I have of significance,
irreplaceable,
is not really wisely used by following other stocks except NVIDIA. Now, for example, yesterday, Mark, do you remember this morning program? Remember when Boeing went down 5%? Okay. At the same time, NVIDIA, at the same time, I should correct myself, went up 5%. So I can imagine that Boeing is a very substantial company. It's all American, it's a giant, NVIDIA, a little software company going back and forth here and there. So imagine two U.S. average, let's see, mid-level managers working together in the same office. One has NVIDIA stock in his portfolio, one has Boeing in his portfolio. And they're working together, they're coming to the office, the market opens, and to the horror of Boeing investors, the stock is going down 5%. Now, an NVIDIA guy, it goes up 5%. You know what? They will stop talking to each other in no time because one is being punished by buying all the essence of America's investment vehicles, great Boeing Corporation, losing his pence. And if it will go down just the way it is, if he bought it with margin, he will still, what he's going to do? He's going to start selling his furniture. I don't know what he's going to do now. The other guy on NVIDIA, he will go to vacation from his profits. Okay, so this is very important to what each guy is doing in his life with his investment. This is very, very important. And with that, I would like to thank both of you for today's program. We'll see you next week, same place, same time. And have a great week of investing. Thank you very much, everybody.
Thank you.
Sounds
Good to
good.
see you, Mark.
Yeah.